All right, folks, welcome back. So this is our Monday commentary for SEC Mentorship for December 6th, 2021. And I want to teach you a little bit about navigating small range, low volatility days and give you another tape reading exercise as well. But before we get into that, I want to take you into the calendar, which is something I have not been doing, but you all have been trained to do this anyway. But you can see here on Monday, there hasn't been any real volatility injections except for the pound. And we don't really have a whole lot going into Tuesday either. So we have medium impact news for Euro tomorrow, but as of today, Monday, nothing for dollar, nothing for Euro. Those two markets are in very small ranges, and the range is defined by last week's dealing range, and I'll look at that with you when we get into the charts. But I want you to think about what the economic calendar is communicating. The probabilities for a lot of volatility, in other words, a lot of movement, a lot of energy in the marketplace, it is not showing the likelihood of that. Notice that? It's just a lack of real important medium impact or high impact news drivers. Okay, so no speeches, no kind of heavy handed data that's going to come out that would cause some kind of interest or disinterest in the marketplace. Because of that, and the technicals, okay, the technicals that we'll look at when we get into the dollar and euro, blending those two elements together equates to small range, low volatility days. So if we can forecast those instances, would those be the days that you would want to sit down and play Keno or lottery? In other words, putting live money behind those types of days? No. I would humbly submit that you shouldn't do that. And I think you'll see why in today's teaching and the lecture, because these are types of lessons that are rich in their depth and practicality. So if you have ever done any trading with live funds and you got into a move and it starts to move a little bit in your favor and you think it's going to go just a little bit more and you get really, excited about if this gives me that couple more pips, oh, I'm going to be so happy because I'll be able to get out, or I'll take half the trade off or more than half the trade off, and I can sit in that really nice sweet spot where I've paid myself, I've moved my stop, and even if it turns around, I'm good. But it doesn't do it. Today, you're going to learn why that happens and how to avoid it. All right, so we're going to look at the dollar index daily chart, and we have the draw on liquidity is still framed up here. Now, I want you to take a look at what's been going on here. We have dollar narrowing into smaller ranges into what is classically referred to as like a pennant or a triangle. Now, while I'm not trying to build the case for trusting these types of patterns, it is noteworthy to suggest that this will eventually lead to some kind of a volatility expansion and movement. Okay, and I'm trusting the higher time frame order flow to be bullish, and I'm looking for that 97.50 level as an upside draw minimum. Okay, and then we have the obvious consequent encroachment, which would be the midpoint of that, and what would be, I guess, looking at eyeballing it, looks like 97.90, maybe 97.90-ish. I'm not sure exactly because it's below the 98 big figure, the premium high of this range here. So this is the objective I'm looking for. Obviously, you can go to the consequent encroachment, which is the mid part of that imbalance on the weekly chart, and the premium high. So we have three specific price levels. We don't have a zone. Okay, even though the rectangle is shading the area that is the draw on liquidity, there are specific levels there that I teach you, and it's the low-hanging fruit one is this one here. Always try to aim for that one. And if you're trying to take partials, the majority goes off there. Then reach for that consequent encroachment. If you can get something off there, split the remaining balance off at that level, and then leave whatever that remainder is to try to see if you can reach that premium high. You may not get it, but it doesn't make a difference. I'm thinking, higher time frame, order flow, momentum still bullish. It's, to me, I'm going to side on that. Now I can fall on that sword and be wrong, and it's okay. I'm not concerned about being wrong because the logic I'm using will serve me and you for years in the future because you're submitting to the process and you're submitting to the underlying pinnings of the marketplace, which is nothing here has shown that the dollar is weak. Nothing has shown that the dollar is turning around and going lower. So you have to stay with that narrative, even if you think you see something on lower time frame charts. I know it's hard, especially if you're new, but you have to just continuously look for that underlying narrative to make its way into the charts, as we'll indicate and show today. In an example, I did some recordings with some tape reading on the euro and dollar. All right, so here's the dollar index hourly chart, and this is the dealing range we're stuck inside of. We have this dealing range high and low. So all of this volatility from last week, all these little tiny little micro moves in here, while they are still something that you can study, and yes, you can scalp them, we are not above the high or below the low. So for me, and how I'm teaching you with my students, to look for high probability and when to anticipate expansions in volatility. Okay, so you want movement. How do you anticipate movement? Well, we got to have a displacement. That means we have to come out above this high and then show a characteristic in price action that would indicate that, yeah, we have an imbalance now, or we have stops to trade into, and then we can look for the next draw on liquidity. Right now, think about this for a moment. Even though I'm bullish on dollar, and I've been trying to illustrate that for months now, if that's the case, and we are anticipating dollar going higher, do you know which day it's going to take out this high? No, you don't. I don't know that either. Now, conversely, what if you're opposing my opinion about what I think is going to happen in dollar? Maybe you think, okay, the dollar's topping out here. Do you know what day it's going to take out that low? No, you don't. So we're inside this high and that low in this range. Yes, it's going up like this, okay, but it has yet to break out, and it might not do it. Think about that. It could go real close to it and fail, and then run down here, take out that, and fake out, everybody that would think that the dollar's going to continuously go higher. Because the market established this dealing range here early in the week on Tuesday, everything that's been going on in here is just small micro moves. That's not a lot of movement. So it creates low probability and low volatility. This market will be low volatility until this range low or this range high is taken out, and then there is displacement after. So what does that mean? What does it look like? Well, we want to see this high taken out, create a short-term high, and then run above it again. Then it creates an imbalance that might be useful to see if it wants to go above here. And vice versa, if it goes down below that low, same thing. We would like to see it break out below that low and then create a short-term low and then break below that short-term low, showing and confirming that order flow is bearish. And if we have an imbalance of some kind, fair value gap, institutional order flow, or optimal trade entry, that would, in my mind, give me a narrative to work with. Whereas right now, what is the narrative? We're inside of a range. We're dealing inside of the range between this high and that low. Now, think about how, if you've been trading for a while, if you have any experience in the markets, typically non-farm payroll would used to, years ago, create these nice big runs like that. Okay. Notice that on non-farm payroll last week, we had it happen on Tuesday, and then it was lethargic and quiet towards the other end of the week when non-farm payroll would be normally expected to create that big event, that carnival ride. It didn't do that. Notice that? It was reversed. So all the volatility came in on the early part of the week, but as the days went by and closer to the close of the week on Friday, there wasn't a whole lot of activity. And while I was able to show something in tape reading on non-farm payroll, who cares? That's a day you wouldn't trade anyway. And looking at the economic calendar, as I open up this teaching and lecture with, you can see there's an absence, a void of real economic drivers that would create the opportunity for the banks to manipulate. Because that's the case, we have to lower our expectations on what the market's likely to do. And how do you know when just not to worry about trading? Because it's real easy to get impulsive or impatient, like I have to be in front of the charts today. I'm going to miss something. Fear of missing out, FOMO they call it. One of the things that you learn here is how to conquer that, and this is how you do it. Understanding the economic calendar and understanding the current market structure and narrative. None of these days since last week are any real reason for you to be in there saying, I have to squeeze this lemon to get the last drop of juice out of it, okay? You don't. You need to sit back and just let that range that's been defined here, let that be broken. And let the market speak to you from a technical stance of where the next displacement forms. And then you can go in and just casually say, okay, I'm going to engage now because I can see what it's likely to do now. Whereas right now, we don't know really. I can have the bullish bias all I want with the dollar. But until this high is given way, it's just my opinion. It's a conjecture on my part. It hasn't been established. So, we have to consider that as a trader. You have to know what the economic climate is, what's the market structure, what's the underlying narrative right now. We're inside of a range. We have yet to move outside this range that was defined by Powell speaking last week. Because that was framed on his jawboning session, whatever those factors were, and I never care to know what he says. I don't care, because I want to see the storyline in the candlesticks. I want to read the narrative and the trade psychology of the market in these little candlesticks. They're going to tell me everything I need to know, because fear and greed is written in these candlesticks. And everybody wants them to do whatever they want them to do. And I'm waiting for them to do what I need them to do, which is leave this range high or leave this range low. Now, don't confuse this with, oh, you're a breakout trader. No, I'm waiting for the market to break out of this holding pattern. And then after it breaks out, then I'm waiting for further evidence that there's another displacement to occur after that. And since we do daily updates, you'll be tipped off to what that is when it and should it form. But until we leave this range, and I know I'm probably boring you to death about this, and some of you probably already got it, but I'm speaking to the ones that really don't understand really what I'm getting at here. Don't feel like you have to be in front of the market every single day when the market creates environments like this, where the economic calendar is really not exciting at all. It doesn't have any medium impact or high impact news. So there's really no likelihood or probability that there's going to be a lot of volatility in that day. Add to it that we're stuck inside this dealing range, and it creates a 50-50 scenario. It could take out that high here, or it could take out that low. Do you know which one it's going to do? No. Do you have an opinion of which one you would like to see happen? Probably. Most of you probably want to see the same thing I've been saying and telling you up front, that I would rather see dollar go higher, and that would suggest that the high is going to be broken. But there's nothing guaranteeing that, and it has yet to do it. So you wait. You don't fear missing out on a move because the move hasn't really established itself yet. Nothing here indicates that you should already be in the marketplace right now. But that does not negate or remove the opportunity for you to go in and study intraday volatility and liquidity, because by understanding what I'm showing you in this lecture, it will help you differentiate when you should be focusing your time and energy, and if you ever decide to go with live funds, what it will not look like, preferably, when you are doing it with live funds, should you ever decide to do that, which I don't recommend doing because we're all demo wallers here. All right, so in layman's terms, I'm showing you by contrast today, yes, my tools will work in these low volatility, low probability days, yes. But just because it does that, don't feel like what's the point of me doing this if I'm not going to take a trade live? I might as well just get paid for doing it. And if I'm right, it's going to feel really good. Well, what happens if it's wrong? You're going to feel worse. Versus you're honing your discipline, saying, I'm not going to engage right now because it's low probability, but I'm still going to tape read, I'm going to do annotations, I'm going to watch it live or watch it play back in the replay button if you have no opportunity to see it live. And you get that experience. And by having that, it is retained in your subconscious. So that way, when you do look at the economic calendar, it does have medium or high impact news events, and the market structure is supportive of a larger magnitude volatility expansion intraday or over the next couple of days, which is not clear at this very moment. Then you'll feel more confident that yes, risk assumed under those conditions is worth it. Whereas right now, it's iffy. It's 50-50. It could be or it couldn't be. And you don't want to be executing with money that you could lose on low probability conditions like that. So knowing that helps you trust what you're doing as a study, but you're not led into by enticement to put live funds in there and then get caught offside and lose and then feel worse about it. Okay? All right, dollar index 15-minute time frame. Okay, we had the order block right here. And actually, let's go back up. I didn't do a good job there talking about that. We have a bullish order block right here. So we had a discount array there. These lows, we'll look at that when we drop down to the 15-minute time frame, but just know that line is the bullish order block there. Okay, on the hourly chart. Again, the bias says bullish dollar. The expectation is low probability, low volatility. Okay, so when the market trades down into the order block, it does this. Then it creates these flat lows, relative equal lows. It runs up and then slams down, clearing out the sell stops. So then the market's allowed to rally. When the market creates this condition inside of a bullish order block, and we are looking for higher prices in dollar, that means on euro, we should see a higher high on euro. When it make the lower low here on dollar relative to that low, euro should post a higher high exactly at the same time this dollar creates a lower low. And we'll look at that when we get into the euro dollar. The market creates a volume imbalance in here, rallies through here. So we have low, high, lower low, up close candle. That is your breaker. You can trade inside of that if you're committed and your convictions are strong about where you think it's going to go, which is right here, this spot side liquidity pool, and maybe up here. But you'll see when I did a tape reading, I already indicated that the likelihood of the second level of liquidity would probably not be taken today. So that way you understand, I type it out in the chart, so it's not like something that it was an afterthought. It's absolutely being communicated in the lesson today, and I'm actually going to show you, reading it live, recorded live. So we have the volume imbalance, runs through, it consolidates inside of the bullish breaker, which is this up close candle here. And because we have low volatility, and this is a bullish breaker, this is how you trade inside of the breaker with the expectation it's going to move higher and not wait for it to run out and then come back down in, because the volatility is going to be so low, and look how close you are to that high. So if it leaves the breaker like it does here, why would you elect to wait for it to get up to something like this and then come back down in? Because that might be a failure. It may not want to go back up to here at that time, because why? The economic calendar says it's going to be slow, and we're stuck in that dealing range as I've indicated on the hourly chart. Now, big, huge step in your understanding. Since we're inside of a bullish breaker here, and we're expected to run to this buy side liquidity pool, and it's a small range, that's only about 10, 15 pips, right? So we don't need to, I don't need to, and this is why sometimes when you see me doing my live executions and I'm annotating the chart, you see me entering right inside the breaker. And a lot of you will, and folks that are on YouTube, in that community, they'll email and say, how did you know to enter before the breaker was traded back to? I'm teaching you that right now. It's all relative to the narrative, the volatility that's expected, and where are we at in terms of the market structure. The market structure is literally indicating to you that we're stuck inside that hourly dealing range. So that hourly dealing range, since it has not given way, it hasn't moved higher or lower outside of it, everything that we trade on, all of the moves are micro level. They're not sustainable runs. They're not big, long trending moves. They're just running for the nearby liquidity. So if we've seen the sell side taken out here inside that bullish order block, and then we had this bullish breaker, while the market's trading right in here, you can be a buyer there and expect the market to expand on the upside, but not to the degree where it's moving hundreds of pips, just running up to take out this buy side liquidity here. And because it's in a low probability condition and low volatility day because of the economic calendar, it may not take this high out. So this is where you take the majority of your trade off, or all together take it off. And then you won't suffer these types of deep retracements. Eurodollar daily chart. Okay, you can see here we have the market. It looks still heavy to me. Okay, and if we take out the rejection block on this candle here, on a closing basis, that to me sets the stage for a run into here and maybe even higher, maybe a reversal. Okay, because I'd like to see it just wilt and go lower. And we have ZOO tomorrow on the economic calendar for Eurodollar, so we'll see if that's going to be any impact or not. But I'm thinking down here still, I'd like to see it draw down into that imbalance a little bit more, and I like that 111.68 level still. If we lose this imbalance and it trades below it, there's a small little fair value gap also at the 110 level on Euro. But I don't want to draw too much attention to that or cheerlead it right now because we don't know. I don't know if it's going to break out of that hourly dealing range like I would like to see it do. So don't read too much into it. I'm just suggesting that to have it on your chart for your own studies. All right, here is the Eurodollar hourly chart. And again, you can see where we traded from last week at old imbalance during the PAL session. And small little ranges, dealing lower, hasn't taken out that low yet, and nothing suggests in the clearest terms that it's going to. So that's why you have to be very careful. Try not to marry the ideas that you're getting in on these trades with, or try to impose your will on it. It's not a bad thing to have your convictions about what you would like to see, but don't hold fast to that so hard that you can't be flexible if the market shows you clear indications that your initial idea or analysis was not in line with the marketplace. You know what I just said there? Wrong. In other words, I'm wrong or you're wrong. But it's less painful and it doesn't sting as much to your subconscious and your ego when you say your first or initial analysis was not in line with the marketplace. A lot more receptive when it's spoken like that. And that's how you put it in your journal. You don't talk toxic or negative about yourself saying, oh, I got that wrong, or I got that wrong again, or this isn't working for me. If you do that, you're feeding yourself toxic narrative. Not narrative in the sense of the market, but narrative as a characteristic trait for you as a personality trait, let's put it that way. You're feeding yourself the negative aspects of the things that you're doing versus finding the silver lining, okay, and keeping yourself on a positive learning curve, because you can't learn this right away. It takes time. It's so many variables. There's so many things that you're going to encounter that will help you find what your specific setup is that you're going to wait for, and when it forms, you're going to go in there and trade with it. I don't want you looking for your specific trade of choice or setup or model, okay, in these types of conditions. Because if you do that, you're going to feel like you have to trade because you put yourself in front of the charts. And you're going to fear missing out a move. So those conditions are ripe for failure. They're ripe for drawdown. And then if you have a losing trade and you don't have convictions or discipline or responsibility, that's the first step to blowing your account. That first losing trade that you did, and you should have never taken the trade in those conditions, as I'm teaching you here. And then when you do lose with live money, you feel like you got to get it back right away because that'll fix it. That'll put the Band-Aid on it and then the boo-boo's gone. But that won't fix it because sometimes you're going to rush to get into something else thinking it's going to get your money back, and then you're going to compound that loss into something more. And then you're going to have fear, greed, and fear of missing out. All three of them coming at you at one time. Plus regret because you didn't listen to the rules. So when I teach lessons like this, these are worth the entire membership's fee. because it helps you remove all those ideas about, I'm impulsive, Michael. I need to know why I should be staying out of market for this particular day. How do you know when not to trade? How do you know when you should go in and trade? What differentiates that? These lessons like this. Because if you understand what I'm showing you and teaching you, and I mentioned last week, until we leave that range that was developed last week, we're in low probability. We're stuck inside the range. So we are dealing inside that range. So therefore, we're trading inside that range. So unless you are capable of trading on a 1 or 5 minute chart, you should not be trading at all. Period. So euro dollar doesn't create that higher high. Notice that? Whereas the dollar index created that lower low, euro failed to do that. That's SMT divergence. It's bearish. So at that time, it's qualifying and confirming that a higher dollar running into its buy-side liquidity pool is likely to occur. So the mirror image of that on the euro would be taking out this low here, and maybe if it could expand low enough, take out that low. But remember what I said, it may not reach for 2 levels of liquidity. It's just going to reach for the nearby liquidity, and that would be underneath this low right here. Now, looking at it like this, you can see, well, it looks like it went right down to that low. And it actually does by 1 pipette. It goes below it just by 1 pipette. But it doesn't really sweep it. And that's the element that I want you to really take away in this lesson, because if you're selling short on euro, with everything else that's been shown here, there's nothing wrong with taking 10, 15, 20 pips out of it. But don't marry the idea and think, oh, you got a runner. It's going to break out this and then break out this and then go down here. Don't do that. Not on a day like this. No. You don't want to do that. You want to study it, not with live funds, and then say, okay, I would expect it to trade below this low, and then we'll see if it can run below that low. And you submit to that likelihood of being wrong. But you've already anticipated this likely low not being taken out. And it's rewarding when it doesn't do it. It proves that you're honing your skill set. You know what you're looking for. The visibility of reading the algorithm and to tape reading, it grows in your understanding. And it gives you such an incredible level of confidence. But you won't get that right away. Okay? Some of you young folks in here, you want it immediately. And it doesn't work like that. You can't just say, I watched the video or I looked at this a couple times over the last couple months, and I should know it by now. You're a liar, okay? You're lying to yourself and anybody else that you say that to, because this is extremely complicated things, and you cannot learn them very quickly. You have to expose yourself to a lot of time, a lot of price reading, back testing, and then you will see it over time. A lesson like this would be probably very boring on YouTube. People are like, I'm not interested in this. And that's the reason why most of those students that would have the view of this type of lesson, that's why they quit. That's why they fail. That's why they'll say these concepts don't work, because they don't know how to plug and play the concepts in the right market structure, in the market environment. We are inside this dealing range. It has to leave that. The algorithm is stuck in small ranges until this range is taken out. And I want to see the dollar go higher, but I don't personally care if it does, because I'm looking to set up the next stage of trades after this range is given way. I have a preferential choice of seeing higher dollar, but I'm flexible, okay? I'm flexible in the sense that, okay, I might be offside in my expectations, and it may go lower. I don't care. It's not going to demoralize me. It's not going to wreck me. It's not going to ruin me. It's not going to change the delivery of my concepts. It's not going to make them less effective. It won't reduce me as an analyst. It won't change my ability to find new setups. You see where I'm going with this, right? Okay, so I'm not making this trading day a be-all, end-all, panacea, or definition of my prowess as an analyst or trader. I'm just looking at, from a realistic point of view, the probabilities are low. The volatility is expected to be low. So therefore, I should be executing on a very low time frame and have my low-hanging fruit objectives clearly defined, and it's the nearby liquidity. That's it. And that would be referenced by this low here after the SMT divergence confirmed that euro was unable to make a higher high. Dollar went lower to take out liquidity inside of its bullish order block on the hourly chart. It should trade for its buy side liquidity, so therefore the euro should trade down for its sell side liquidity. And if we're lucky, if it goes below this low, great. But if it doesn't, we're not surprised. Now think about the command and control over yourself if you can think like that before it happens. That's not communicated in books. It's not communicated by any other teacher out there. They don't teach like this. These are the real nuts and bolts, rubber meets the road type of teachings that I avoided for years. And until I submitted myself to these types of things, this is where I had the greatest learning curves, because it removed a lot of the things that were in my way, which was namely myself, wanting to trade because I have to trade. I got to get out of my job. I have to do this today because I'm sitting in front of the chart and I can't waste my time. You know what I'm talking about. I don't need to give the whole laundry list. Those things that you feel that are psychological barriers, but it's so easy when you don't really fully understand what you're doing. It's easy to say, oh, these concepts don't work. No, these concepts work. But you're trying to make a hammer do the job of a screwdriver. You're asking a fishing net to be a umbrella in a hurricane. They're impossibilities, folks. And they may be extreme analogies, okay, but to me, that's how I look at it when my students come in and they just traipse through a couple months and they think, oh, I should already know how to do all this by now. Man, you're fooling yourself. You have not given yourself the time or the opportunity to fully digest a full calendar year, see what the market offers, and when it consolidates, when it expands, when it has trending models, when it has reversal models. All those things have to be interpreted real time. And you navigate that with me because I'm basically pointing it out, saying, okay, this is what we're doing, this is what we're not likely to do. And you learn by example. But these lessons here, if you understand this, these lessons will keep you many times from blowing your account. I'm not saying you can't blow your account in other ways, but this is where people hurt themselves the most. They do more trading and they overtrade and they force trades in these types of conditions. And you can't do that and expect to be successful. Every single time I've ever done that as a trader, every single time, it has always been an adverse result. I was not happy with what I did. And I was angry at myself. And I used to fault the things I was trying to apply. And then finally I said, you know what? It's me. I'm that thing that's messing it up. So what is it I'm doing wrong, and what things am I repeating over and over again? And when I did that, I discovered it's these elements here that I was trying to force into opportunities that have lots of magnitude and opportunity and movement when it doesn't offer that right now. So when I tell you in the commentaries, in just passing, comments saying like, we're in low probability conditions, you're getting a real in-depth view of what I've been referring to when I say things like that. We're looking at the internals, the underpinnings of the marketplace, what makes it low probability and low volatility. Again, it does not mean that you can't go in and study. You absolutely should be studying this stuff on these low days like this. But don't try to trade them with live funds because they will frustrate you. They'll trick you into thinking it's going to really run when it's not. It's not going to do that. You ask questions to me sometimes in emails to say, how do you know when it's going to create an optimal trade entry versus when it's going to take out an old low or an old high? Well, conditions like this will help in that sense because you know the likelihood of a range not giving way when it's in low probability conditions like this. There are times when the market's bullish and we're in a low volatility expectation where the calendar is really quiet and it creates an opportunity where it trades down to a low but doesn't take out the lower low, and that sets up the stage for an optimal trade entry buy because the underlying pretense is bullish. It's going higher. But if you know that the range is unlikely to break when it's dropping down and you factor in all the other things that you learn in the core content, you don't have any fear of it going lower. You trust the fact that it's trading down into a bullish order block with a fair value gap and optimal trade entry in a time of day on a day that it's expected to trade higher, and then you trust it. That's the recipe. But just because you have the recipe and you mix the ingredients together, if you're not paying attention to everything you're doing, you could leave that thing you're cooking too long in the oven. Did the recipe cause that outcome? No. You, the baker, did. But it's easy to say, oh, I had faulty ingredients. Oh, that oven did it to me again. I got to get the settings checked on it. You got to be responsible. So these lessons help you develop responsibility and discipline. Being in control of yourself. Not saying, oh, I'm going to go in here and throw the dice. No, you don't want to do that. You observe and learn, but you don't risk in these environments. I told myself I was going to give you all this coaching in this lesson, but it's too good of an opportunity not to do it. So that way you guys can get it, hopefully get it in this lesson and not need a whole lot more of them. All right, so here is the 15-minute time frame for the euro dollar, and we traded down below the low here after creating the SMT diversions. It trades back up, immediate rebalance in here, breaks down, consolidates, and rolls out of that. Attacks sell side, goes right down into and 1 pip at below that low, and fails. Now, I did a tape reading session, and I annotated this low saying it's possible, but it's probably not going to take out that low because of the low volatility conditions and the economic calendar. It just doesn't support the idea of a big range breakout and trending move type of event. But drawing below this low here, certainly good enough, and it draws all the way down to that low. So once it does that, notice what happens. It comes right back up to this imbalance and where the entry essentially would be going short on a bread and butter type setup. So in other words, getting short in here with the expectation of running below that low, maybe tagging that low here. That's the run that you would get, but you have to get out. Otherwise, this type of retracement here, or altogether come back even higher, maybe you can take out this and still stay inside the range that was created last week. And it would be a waste not to have taken out partials here in your paper trade, in your annotation study, okay? I don't want you thinking that these conditions are going to allow you to go in there and every single day, tap dance and get 20 pips. These are the days that you will likely get it wrong and get hurt. So if you can identify them beforehand, navigate around them, study them, but don't engage, not even with your demo account. Don't even do that, because to do that, it cultivates bad habits of chasing new pips, chasing new opportunities in low volatility, low probability conditions. You want to learn discipline and say, yeah, it could do this. It could go down and take that low out, but I'm not going to execute on that. I'm just going to study it. And I'm going to feel good about the fact that I didn't do it because I'm exercising discipline. I'm controlling my fear of missing out, and I'm replacing it with responsibility and depth of understanding. There's a huge chasm between those two characteristics. The retail-minded trader has no interest in being disciplined or responsible. They just want to give me a setup, let me get in and make my money. And they don't even respect the level of risk until they're ready to get stopped out or they get margin called. Then it's suddenly an interesting topic of risk. But they don't want to identify it or consider risk or the personal responsibility involved until they blow their account. But then at that time, a retail trader will say, oh, it's the guy I learned from, or it's the system I tried to use, or the methods don't work, or it's the broker that did it to me. That mindset is someone that's never going to succeed versus someone that says, okay, these are the things that keep repeating in opportunities that are low probability. So it's profitable for me to understand in great detail what they look like so I can observe them. So therefore, in the future, when I see them coming, they're like a landmine field with signs of don't step over here because there's landmines in here. That's what this is. It doesn't mean you can't navigate through a landmine field, because you could get lucky and walk through and never touch a landmine. And that's what retail traders do. That's exactly what happened with me. When I first started trading, I got lucky and I had a period of luck. So it's easy to think you have skill, and you didn't. You just got lucky and didn't step on a landmine. But then eventually, in the following year, I stepped on a landmine field, and everything I stepped, it just blew another appendage off. And finally, I was like, I got to stop and figure out what I'm doing wrong. This helps you avoid all of that, and it gives you peace of mind. Doesn't it interest you? Stop what you're doing right now. And if you've been bored up to this point, shake yourself. Take a deep breath and think, How much more confident would you be if you know where you're likely to get it wrong and you avoid those conditions? Wouldn't you feel good about yourself if you knew what that was in advance and you had the discipline to say, I'm not even going to worry about putting on a trade, not even a demo, but I'm going to study it with the expectation of trying to read what the tape's going to do. And I'm going to feel good about the fact that I've done that because it's responsible and I'm in control of myself. That builds discipline. That does not happen right away. It does not happen by watching a video. It happens by you getting in the charts and watching it, studying it, back testing it, either with a replay button, so you're getting the closest thing to real time, or record the day's data with screen recording device, or watch it live if you have the opportunity to do that. By doing it, it empowers you. It really gives you the I'm really reaching for a word because everything I've said here, it doesn't really fully capture the mindset that it gives you. Because as a mentor, I get so many questions about how do I know this and how do I know that? Because of these types of ideas and concepts blended together with experience. So when you understand how they all fit together, this is why you understand more when you have a lesson like this, that you just can't take 1 month of core content and say, oh, I really like that, and now I'm going to know how to trade. No. You have to have the complete, comprehensive understanding of everything I'm teaching. And I'm not spreading it out so thin to keep you here longer just to get money. It requires time, folks. It requires time. You have to have these instances where they creep into the market real time. And when those happen, and they happen a couple times a year, you need a full calendar year. So that we have experience, you know that these things still communicate to you what the market's likely to do, but it is not an invitation for you to go in and lose money because you're not properly defined as a, responsible, disciplined trader. You have no discipline. None of you. You're so new at this. Well, I say that, folks. Just know I'm talking to the 2021 group. You don't have the discipline yet. These are all new weapons, okay? You have not been fully trained how to use them. You're trying to put a clip of rounds in your firearm that you've never had an opportunity to fully handle yet and learn the safety protocols to holding them and using them safely. Many of you, especially the men, think, oh, wow, this is something new. This is something awesome. He taught a new entry technique or this or that thing. And I want to get out there and be Rambo and just level everything and empty your clip into the marketplace and then take off with all the money. That's imagination. And imagination many times can get you in some serious trouble here in the marketplace. So you want to be disciplined. You want to be mature about what your expectations are and sober-minded. And all those things are a result of knowing these types of events and these conditions in the marketplace. So, before I go into British Pound, doesn't it make sense to know this? Like it removes fear. It removes the impulse that you have to be in there every single day, and it defines when you shouldn't be. How much more effective would your trading have been and your learning if you could have applied this idea and mindset to knowing when you shouldn't be in the marketplace, but still knowing that the market's going to move around, yes, but reducing it to, okay, I don't need to be in front of the charts today. How much better would your learning curve have been? And or if you mistakenly made live trades before you knew what you're doing, how much money could you have saved yourself by having known this? I can personally submit that I would have saved myself a lot of personal pain, a lot of grief, and a lot of money, and lots of accounts, because I blew lots of accounts when I was a younger man, 20 years old. I just didn't care. The money wasn't the fear. The fear was I was never going to learn how to do it. And I just kept plugging. I'm thankful that I've learned these types of lessons to help control myself, but I can't just dump this into your understanding. You have to get in the charts and see it for yourself. And the way you do it is what I'm showing you here. All right, finally, we got to British Pound. I promise we won't be here long. All right, so we're looking at the daily chart for cable, and this thing still looks heavy to me. Okay, I think it still wants to go lower because that's in concert with the idea I have for the dollar index likely going higher. It doesn't mean I'm right, doesn't mean I will be right, it just means that I'm favoring the lower side on the downside on cable. On the hourly chart here, just a real just sloppy day. I mean, it's gone back to a rejection block and then sold off here with strength on the dollar, just to an imbalance in here. These lows here, I think they're suspect. They may want to take those out. I'm not suggesting with any degree of certainty that it's going to take out the low here. Obviously, that's the scenario I would like to see because the higher dollar would fit this model of taking out that low. But I'm just thinking here because we have Tuesday's economic calendar. It's not a lot going on. So if we do have any breakdown on the cable market, just factor in here. In this instance also, it might just go down below these lows here and not take out that low. Kind of like a similar idea that it happened in the euro. I'm not trying to press that one too hard, but just consider that also if you're watching cable. And again, here is the intraday price action for British pound. Starts off running, pulls back in, and one more run up into, again, just the rejection block. And this run is inside this dealing range, which is, again, another dealing range it's stuck inside of, plus the one from the hourly chart from last week. So it makes it more difficult, and it makes it hard to find safe entry points and manage your stop loss. That's the benefit I've learned in my own observations over the years, knowing what I'm teaching you in this lesson. How to stay out of the marketplace, even though it might move around a little bit. The little bit is the real characteristic. I don't want to be in something that's not likely to have a lot of movement, because if you have a lot of movement, it's forgiving. You might not get a trade that pays out, and if you get stopped out, but it's still moving around, I can probably go back in again if things are still there with time and price for that day. I could probably pair that loss to something that's more manageable, or altogether make it back and then show a profit. While that's not important, it's just better to try to take some of that loss away, but not force it. You have better opportunities when the market is likely to have bigger range expansions intraday versus the low expectation and low volatility days like this. And you don't know where the clearing entries are going to be. You don't know how to really work your stop loss in without them coming back deep against you in some kind of sporadic move just to run off on the liquidity that would be otherwise trailed up. In other words, these are the days that could potentially be squirrely or just staticky, where, yeah, it might go to where you think it's going to go, but did you hold that trade without getting stopped out before it gets there? That's what I'm kind of trying to communicate to a layman that's listening. All right, Bitcoin. Just want to comment on this one before we go into the tape reading portion of this commentary. As I mentioned in this community, I mentioned that how we're up in here, we're looking to break down. I mentioned that these lows here are suspect, and I felt that, and I made this comment public on the community tab months and months ago, that I didn't see anything above 62,000, and while it did go higher, obviously, it's failing here. And we had a nice breaker, that's what I'm indicating here. It stagnated around into that, and then finally it just, over the weekend, it just fell out of bed and wilted. Now, I'm disappointed in myself because I had intentions of making a post about this area right in here. Now, I would not have been exactly to the low, but I was trying to think about, drawing attention to this one right here. And then if it takes out these lows here, you got to be watching out for these lows. Ultimately, unless this thing completely reverses and rips the face off of anybody that's bearish, I still believe that this is where they're going to take it. Now, does it happen real fast? I don't know, but look at this. It dropped, like 20,000 points. 20,000 points. I was up here talking about on YouTube. I said my mood was to take out these lows here, and from that point, it just that's 20,000 points. Good grief! That's enormous. I'm not sure. Honestly, I'm not sure if I was trading crypto, if I could hold on to something like that. Like that's it. Just to me, it would mess with me psychologically. Like that's a lot of movement, and seeing it break down like this to me doesn't bode well. I don't have a whole lot of faith in this asset class because it does a lot of things that doesn't make sense to me. And I don't see that as a weakness. I see it as I know enough to know I don't know it. Okay. So if I'm honest with myself and I'm honest with all of you, I don't know this asset class. And when it does things, it does it in such an exaggerated form that it's to me frightening because I don't think I would be comfortable even in a winning position. Like if I was short and it was just coming down thousands and thousands of points like that, dropping, like that would cause anxiety for me, admittedly. Like I would probably get to the point where I would lose clarity about where I'd want to get out at because it would be moving so fast and the velocity of the movement lower would make me think it's just completely crashing to these lows here. And I'm being honest with you because I've never seen a market move like this thing does. And that's also another reason why I don't want to trade it because I know enough about myself. I'm not fearful of getting in trades and I'm not fearful of losing money, but I am fearful of myself when it's like very fast, ferocious type movements because I've had some of those types of moves in commodities. And I know the characteristic in myself is I abandon sound logic about exits. And this is one of the things I've said many times openly here in the mentorship. And I think I've said it also on YouTube. My weakness as a trader is the exits because I'm looking for the perfect one. And that pursuit of perfection could be many times deadly. And I'm not confident that I would be able to manage myself effectively in moves like that happened over the weekend where it just completely fell out of bed. Like that was, that's a big move, man. From in here, dropping like that. That's pretty freaking crazy. But I got people in here, and I have people in the public community on YouTube that swear by my concepts in this stuff, and they apparently they find trades that pay them. I don't know. I just think that would scare me, and I wouldn't want to trade this market right now because it's already wiped out a lot of people and we're inside of the retracement. There's a long wick down here. Think about where that midpoint is. I think it could revisit that. If it trades below it, and then we'll resume being bearish. But as long as we're above the consequent encroachment of this wick here, just expect consolidation to retracement. All right, and I think that's going to be it for this. Let's go over to the tape reading portion of this video and hopefully you get something from it. All right, so we're going to look at a low volatility, small range day as a result of a lack of any calendar event, and we're also inside of a larger dealing range that we're waiting for markets to break out of relative to dollar and euro. All right, so we're looking for a dollar to move higher into that buy side liquidity pool. And the sell side liquidity pool may get tagged today, but I noted that it might not do it at all because of the low probability. And this is a voiceover because it was a very slow delivery of price. Obviously, you can see everything's mapped out ahead of time. There is a SMT divergence that is the framework on this idea here. So it's not a trading or trading day that I would particularly. It's not a particular day that I would actually trade in, but just for visibility's sake, you can see that the dollar index is trading inside of its bullish breaker after forming its lower low, but yet the euro dollar on the right hand side failed to make a higher high. So that's SMT. It's qualifying the idea that this market is likely to go for sell side on euro, buy side on dollar. All right, so I'm basically suggesting that in this area, we should be starting to see range expansion moving lower to attract the sellers in the marketplace, pull them in because of the low being taken out on euro. That's what I'm anticipating here. This small range day can create these lethargic little consolidations that are sloppy. They have almost noise-like, and I hate to say that word because I've in the past made reference how lower time frames, when it's liquid, when the markets are liquid and the markets are symmetrical, it's not noise. But when it's in conditions like we're in right now, yes, you can read it, yes, you can forecast it, but it's not so clean that you should be actually engaging and entering it. But practicing in these conditions, this is how you navigate in these small, low volatility days. It builds your understanding of liquidity, it builds your understanding of order flow, and it bodes well for your tape reading. So if the market were to trade a little bit higher and take out the rejection block on the euro dollar on its 5-minute chart, that would be an area to go short. You could go short here at the 112.90 level. It's a nice round level. The 113 big figure should be defended because of the SMT divergence, and liquidity below the marketplace has not been thoroughly purged. So we're looking for a run below that 112.75. We'll just call it round it to the 5 level. Okay, and the dollar index has a small little volume imbalance. I'd like to see that stay open, act kind of like a small little micro breakaway gap type event. All right, so that looks promising on the euro. Notice there's a small little relative equal lows on euro on the right hand side. Sell stops are pulling under that and layered all the way down to the old low at 3 o'clock in the morning today. And this is really sped up, so I've compressed like 90 minutes or so, almost 2 hours, I think. Nice expansion on the downside. Now again, if it was a more liquid day and it had news drivers in it on the economic calendar, as I noted at the beginning of the video, there's a lack of any real medium impact or high impact news events. So with that, and here's the main thing, we're inside that dealing range from last week when the Fed chair created that little bit of a expansion in volatility. And then since that day, on Tuesday of last week, it's just been reducing smaller and smaller and smaller. Now, obviously, you saw on Friday, an example of tape reading with non-farm payroll. And I'm not going to sit here and try to promise or even try to do an every single day tape reading event. But today was a good example because I wanted to show you the elements that are going to lead to you trying to use live funds and failing or being very frustrated. And it's going to be in these instances where you have the technicals there, but it's going to be very lethargic in getting to like the second layer of buy side liquidity. Now we just purged the sell side there on euro. So that would be enough. That's a nice little bread and butter setup. Get yourself paid and get out of the trade. But that old low, I just scrubbed those two, it has low probability of trading through that, much in the same way that the old high on the dollar index, that not the one that's being ran out on dollar now, but the one to the left of it. So we have buy side taken on dollar. Now the higher time frame buy side liquidity pool on US dollar. That one's highly unlikely to be traded to. Now, notice what we're seeing here on euro. It's trading right at the old low. But notice the notation I have here. I said it might do it, but don't hold your hopes up too high with it. So you want to be taking your profits and having a very small portion of the trade open in case it runs. But because of the lack of news and the fact that we're inside that larger dealing range that was created last week between dollar and euro, the likelihood on a low volatility day with no real news of running out that low, once it's taken a nice liquidity pull out, as we see here at the 112.75 level, we've essentially purged a nice pool of liquidity. that has seen a run higher. So the London high and the New York high that failed to make a higher high on euro, that should have been higher high on euro when the dollar made that lower low. That SMT divergence, while it did confirm, it does not create the timing aspect. It's the qualifier that this move, while it is very small, it's very micro in terms of magnitude, 15, 20 pips. That's enough to, again, butter your bread. Okay, you're just trying to get a little bit of something each day to study and differentiate when you put real effort, and I'm saying that with my fingers in quotations, and we'll say effort is that green paper stuff. Okay, because I'm not trying to entice you to use live funds. That's one of the caveat emptors, coming into here and being in the mentorship is we talk only in demo and hypothetical conditions. But the way you would differentiate high probability conditions is this is a low probability condition. Now, altogether, we can see that it still is basically delivering on the basis of what I teach and how the market should reach for liquidity. The directional bias, we're bullish on dollar, that hasn't changed. We're looking for lower prices on euro, that didn't change. But when you go into the marketplace, you want to have certain things behind you to support the narrative that you're operating in. In this case, we're looking for a higher run on dollar to a logical buy-side liquidity pool or an old high. But then just above that high, we have another short-term high. And you probably have encountered this before where you get into a trade and maybe you were right and maybe you were short in a move like what we just had in euro. Okay, and it started moving down in your favor. You had 15, 20 pips in your favor. But you started thinking, okay, well, it's going to run out this next new low and I'll get out below there. I'll take a partial there and then see what happens. And then it stops like this. That is frustrating, especially if you hold on to it and it reverses and goes right back to your entry, if not worse, goes into your stop. Or if you don't use a stop and it goes against you and your entry, then you've created all kinds of new toxic thinking. It creates a huge wrestling match internally and emotionally, and it makes you fear the next trade because you were not being disciplined, you were not being responsible with your decision making, your trade management, or your risk management. So having the ideas of what makes the market low volatility and low probability, it doesn't mean that your concepts that you're learning here aren't going to be useful in those conditions. It just means that you have to be much more nimble and contrast this type of movement where, yes, you can see me doing it and you can do it in your own trading and studying and all that, but it's not something that you should plunk live money into. Study it so that way you learn the characteristics and traits of low probability and low volatility. Okay, and I want to make sure you guys know what that means. What am I classifying this day for as a low probability, low volatility day? The economic calendar had really no medium impact or high impact news events. So right away, you already know that it's probably going to be quiet. Then you have to refer to the market structure. Market structure last week created on Tuesday, it had this nice little volatility expansion, a lot of excitement. And then ever since Tuesday, it's been going in smaller little ranges, smaller little ranges, smaller little ranges. The daily chart on the dollar index is creating like a pennant, like a triangle. It's going smaller and smaller and smaller. So while I'm not trying to push the issue and be a breakout trader and predict the breakout direction, I'm staying with the bullish undertone of the dollar. But with that in mind, I'm just using very small, lower time frame 5-minute charts, and now obviously 15 minutes to reflect the liquidity pool in the dollar. Those elements I'm using together to thread a tapestry that shows, yes, there's probability, but it's low, and you shouldn't ever put live funds behind a day like this, but study it, obviously, for your edification. You can see now how we come all the way back up to where the entry would be on the euro dollar. So that would be very frustrating if it was something that you were engaging in with live funds. So while this one isn't all that great in terms of magnitude, it does have a lot of rich characteristics you can draw from and glean more experience. That way you can differentiate low probability and high probability.